Welcome to Broadcom Inc. First Quarter Fiscal Year 2022 Financial Results Conference Call. At this time, for opening remarks and introductions, I would like to turn the call over to Ji Yoo, Director of Investor Relations of Broadcom Inc.
Thank you, Cherie, and good afternoon, everyone. Joining me on today's call are Hock Tan, President and CEO, Kirsten Spears, Chief Financial Officer, Tom Krause, President, Broadcom Software Group, and Charlie Kawwas, Chief Operating Officer. Broadcom also distributed a press release and financial tables after the market closed describing our financial performance for the first quarter fiscal year 2022. If you did not receive a copy, you may obtain the information from the investor section of Broadcom's website at broadcom.com. This conference call is being webcast live, and a recording will be available via telephone playback for 1 week. It will also be archived in the investors section of our website at broadcom.com. During the prepared comments, Hock and Kirsten will be providing details of our first quarter fiscal year 2022 results, guidance for our second quarter, as well as commentary regarding the business environment. We'll take questions after the end of our prepared comments. Please refer to our press release today and our recent filings with the SEC for information on the specific risk factors that could cause our actual results to differ materially from the forward-looking statements made on this call. In addition to U.S. GAAP reporting, Broadcom reports certain financial measures on a non-GAAP basis. A reconciliation between GAAP and non-GAAP measures is included in the tables attached to today's press release. Comments made during today's call will primarily refer to our non-GAAP financial results. I'll now turn the call over to Hock.
Right. Thank you, G. Thank you, everyone, for joining us today. So, in our fiscal Q1 22, consolidated net revenue was a record $7.7 billion, up 16% year-on-year. Semiconductor Solutions revenue grew 20% year-on-year to $5.9 billion, and Infrastructure Software revenue grew 5% year-on-year to $1.8 billion. Now, enterprise demand grew very robustly from the trough we saw in Q1 last year, as the recovery in enterprise IT spending continued to accelerate. Meanwhile, hyperclouds are upgrading their data centers, and service providers, telcos, continue to deploy next-generation fiber to the home. As expected, against the peak of a year ago, wireless grew single digits, and our core software business remains very stable and steady. On the supply front, lead times remain extended and unchanged, as inventory of our products in the channel and at our customers remains lean. Our semiconductor backlog at the close of Q1 continued to grow double digits from that of the prior quarter. Let me now provide more color by end markets. Starting with networking. Networking revenue of $1.9 billion was up 33% year-on-year and represented 32% of our semiconductor revenue. This strong growth was driven by deployment at scale of Tomahawk 4 and compute offload across several hyperscale customers as they upgrade and scale out their data centers. In enterprises, campus switching upgrades continue to accelerate. Let me talk about routing in this space. Investments in 5G backhaul by telco operators worldwide continue to drive strong growth in our Qumran family of products. More than this, the opportunity in our routing silicon has expanded into hyperscale in a very significant way, moving Ethernet into the back-end networks of large-scale AI ML clusters. In particular, I'm referring to the Arista 7800 AI platform, which scales Ethernet to connect many tens of thousands of CPUs and GPUs in hyperscale. This platform is built on our Jericho router. Our devices provide the most cost-effective fabric for AI ML scale-up with an end-to-end congestion-managed lossless network and highest efficiency load balancing across the links. Now, in contrast to proprietary protocols such as InfiniBand, used typically in high-performance computing, we see low-latency Ethernet as the way forward for large-scale AI ML networks as a widely adopted open architecture. Our unique ability to network these complex AI workloads in hyperscale is extending our customized training and inference SoC footprint at several cloud guys. In Q2, we expect networking to continue to be strong across the board and revenue growth to be in excess of 30% year over year. Next, our server storage connectivity revenue was $801 million, and growth accelerated to 32% year on year, representing 14% of semiconductor revenue. This was driven in large part by the continuing recovery of enterprise IT spending, much of which was deployed towards upgrading compute servers. And most of these compute servers use either our MegaRAID or SAN for server storage connectivity. We are also benefiting from increased content as enterprises upgrade to next-generation storage connectivity solutions to support deployment of leading-edge servers. Beyond enterprise, with proliferation of video content in social media, we see our cloud customers increasingly adopting nearline hard disk drives as the primary storage of choice. And to manage these large arrays of hard disk drives, they deploy storage servers and expanders, which utilize very much our next-generation storage connectivity silicon and software, creating another driver for revenue growth. Interestingly, we are also a critical supplier of preamplifiers and read channels in nearline hard disk drives, with our revenue growing at over 20% CAGR over the last 5 years. Our nearline revenue represented over 2/3 of our hard drive business this quarter. With the adoption of next-generation technology here, we're selling more boards than just silicon, resulting in much higher dollar content. This dynamic, coupled with continuing strong demand from both enterprise and hyperscale, is expected to accelerate Q2 server storage connectivity revenue to over 55% year on year. Now, moving on to broadband, revenue of $911 million grew 23% year on year and represented 16% of semiconductor revenue. This was driven largely by increased deployment of next-generation PON and DOCSIS, or cable modem, with high attach rates of Wi-Fi 6 and 6E in home gateways. Examples of this abound. Last quarter, Charter announced trials of DOCSIS 4.0 running at speeds of 8.5 gigabit downstream and 6 gigabit upstream, both in CPE and remote node. Comcast started deployment of their Wi-Fi 6E DOCSIS 3.1 gateways, and AT&T announced a multi-gig PON service on their gateways. All of this are using Broadcom SoCs. We remain the market leader in delivering Wi-Fi 6 and 6E chips to leading phones, as well as routers, enterprise access points, and carrier gateways. Through the first quarter of 2022, we have cumulatively shipped over 1 billion Wi-Fi 6 and 6E radios in just around 3 years since our launch. Our OEM customers and carrier partners are now ramping Wi-Fi 6E, the current generation of Wi-Fi making use of the 6 gigahertz band, which is increasingly been made available for unlicensed access across the globe. And as we look ahead, we are the industry leader, heavily investing in Wi-Fi 7 as the strategic complement to 10G PON and cable modem. We see both broadband. We see this as the next step in broadband development and deployment globally. In the U.S. alone, the pending Infrastructure Act sets aside $65 billion over the next 5 years to connect more homes to high-speed broadband. Across the world, the same is happening as next-generation wired broadband is seen as the better alternative to 5G for home connectivity. As far as Q2 is concerned, we expect our broadband business to continue to grow 20% year-on-year. Moving on to wireless, Q1 revenue of $2 billion represented 34% of semiconductor revenue. Demand from our North American customer for our products continued to be strong during the quarter, driving wireless revenue up 10% sequentially and up 4% year-on-year from the peak quarter in fiscal 21. As expected in Q2, wireless revenue will be seasonally down about mid-teens quarter-on-quarter, but will still be up mid-single digits from a year ago. Finally, industrial revenue of $243 million represented approximately 4% of Q1 semiconductor revenue. Q1 resales of $239 million grew 37% year-over-year, driven by robust demand from electric vehicles, renewable energy, factory automation, and healthcare. Reflecting such strong resales, our inventory in the channel remain around 1 month, and we expect resales to continue to be strong in Q2. Accordingly, in summary, Q1 semiconductor solution revenue was up 20% year-on-year. Q2, we expect semiconductor revenue to accelerate to 25% year-on-year. Turning to software. In Q1, infrastructure software revenue of $1.8 billion grew 5% year-on-year and represented 24% of total revenue. Core software revenue grew 6% year-on-year. In dollar terms, consolidated renewal rates average 121% over expiring contracts, while in our strategic accounts, we average 136%. Within these strategic accounts, $656 million represented renewals on expiring contracts, of which $164 million represented cross-selling, including PLAs, of our portfolio products to these same customers. Over 90% of the renewal value represented recurring subscription and maintenance. Okay, ARR, annual recurring revenue, at the end of Q1 was $5.3 billion, which was up 5% from a year ago. In Q2, we expect our infrastructure software revenue to sustain around mid-single digit percentage growth year upon year. In summary, in Q1, Semiconductor revenue grew a strong 20%. In fact, excluding wireless, it actually grew over 30%. Combined with our stable software business, consolidated revenue grew 16% year-on-year to $7.7 billion. Now, turning to Q2 guidance, we expect semiconductor revenue growth will accelerate to 25% year-upon-year. And excluding wireless, it will be 35% year-on-year. Layering on our stable software business, we expect Q2 consolidated revenue growth of 20% year-on-year to $7.9 billion. And before I turn this call over to Kirsten, I just want to add, Broadcom recently published its second annual ESG report available on the company's corporate citizenship site, which discusses the company's ESG initiatives. As a global technology leader, we recognize the company's responsibility to have a positive impact on our communities through our product and technology innovation and operational excellence. We remain very committed to this mission. With that, let me turn the call over to Kirsten.
Thank you, Hock. Let me now provide additional detail on our financial performance. Revenue was $7.7 billion for the quarter, up 16% from a year ago. Gross margins were 76% of revenue in the quarter and up 227 basis points year-on-year. Operating expenses were $1.2 billion, up 6% year-on-year, driven by investment in research and development. Operating income for the quarter was $4.7 billion and was up 23% from a year ago. Operating margin was 60% of revenue, up approximately 362 basis points year-on-year. Adjusted EBITDA was $4.8 billion, or 62.5% of revenue. Note that this figure excludes $136 million of depreciation. Now a review of the P&L for our two segments. Revenue for our Semiconductor Solutions segment was $5.9 billion and represented 76% of total revenue in the quarter. This was up 20% year-on-year. Gross margins for our Semiconductor Solutions segment were approximately 71%, up 347 basis points year-on-year, driven by favorable product mix and content growth in next-generation products across our extensive product portfolio. Operating expenses were $817 million in Q1, up 9% year-on-year. R&D was $725 million in the quarter, up 10% year-on-year. Q1 semiconductor operating margins increased to 57%. So while semiconductor revenue was up 20%, operating profit grew 31%. Moving to the P&L for our Infrastructure Software segment. Revenue for Infrastructure Software was $1.8 billion and represented 24% of revenue. This was up 5% year-on-year. Gross margins for Infrastructure Software were 90% in the quarter, up 71 basis points year-over-year. Operating expenses were $348 million in the quarter, up 1% year-over-year. Infrastructure Software operating margin was 71% in Q1, and operating profit grew 7%. Moving to cash flow. Free cash flow in the quarter was $3.4 billion, representing 44% of revenue. We spent $101 million on capital expenditures. Days sales outstanding were 30 days in the first quarter, compared to 35 days a year ago. We ended the first quarter with inventory of $1.5 billion, up 17% from the end of the prior quarter, in large part due to higher material costs. Our hardware backlog at the end of the quarter was over $25 billion, compared to $22 billion the preceding quarter, and our lead times remain steady at 50 weeks. Our software backlog continued to grow as well and ended the quarter at over $15 billion. As a point of reference, software backlog was $13 billion a year ago. We ended the quarter with $10.2 billion of cash and $39.5 billion of gross debt, of which $300 million is short-term. Turning to capital allocation, in the quarter, we paid stockholders $1.8 billion of cash dividends. Consistent with our commitment to return excess cash to shareholders, we repurchased $2.7 billion in common stock and eliminated $375 million of common stock for taxes due on vesting of employee equity, resulting in the elimination of approximately 5 million AVGO shares. The non-GAAP diluted share count in Q1 was 446 million. Based on current business trends and conditions, our guidance for the second quarter of fiscal 2022 is for consolidated revenues of $7.9 billion and adjusted EBITDA of approximately 62.5% of projected revenue. Note that we expect Q2 non-GAAP diluted share count to be 442 million. This excludes the potential impact of any share repurchases completed in the second quarter. That concludes my prepared remarks. Operator, please open up the call for questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. We ask that you please limit yourself to one question. To withdraw your question, please press the pound key. Please stand by while we compile the Q&A roster. Our first question will come from Harlan Sur with J.P. Morgan. Please go ahead.
Good afternoon, and congratulations on the strong results and execution. Hock, given your backlog and extended lead times, you've got pretty good visibility into this year. Your end markets are strong, right? Cloud and hyperscale CapEx spending is looking to grow about 30%. You're driving the 200 and 400 gig networking upgrade cycle. Enterprise spending is still expanding. As you mentioned, Broadcom continues strong, whether it's DOCSIS, Wi-Fi, fiber upgrades. And then on your compute acceleration ASIC pipeline, you've got Google, Facebook, Microsoft, all of these guys ramping. So it seems like the demand, your product leadership, seasonality can sustain a sort of low to mid 20% plus type year-over-year revenue growth profile through this year. So I guess the question for you is, do you have line of sight and confidence on sustaining this type of growth through the year? And then more importantly, do you have the supply commitments to support this type of growth?
I'm not providing annual guidance, Harlan, if that's what you're angling for. But what you say makes a lot of sense. And to answer your questions directly, yes, we have line of sight through end of 2022. And both, we believe, in demand and in supply.
Thanks, Hock.
Sure.
Thank you. Our next question will come from Vivek Arya with Bank of America. Please go ahead.
Thank you for taking my question. Hock, I was hoping if you could just revisit, what's driving the acceleration in growth. And then the more important question is that there is a perception that semiconductor companies are benefiting abnormally because of a pricing lever, because of the tight supply conditions. And as the foundry capacity eases, that your costs will go down and the pricing advantage will disappear. And I was hoping you could give us some more color. How much of a role is pricing playing in the expected sales growth this year on a like-to-like basis versus what you saw last year?
That's a very good question. And in truth, the real demand that we're seeing underlying, if you talk about underlying trend that is sustainable, at least in this typical upcycle, you're right. It's while we're showing 30% in networking, 30% in server storage, a part of it is driven by ASP increases simply because we are passing on our material cost increases, wafer substrates, assembly, to our customers, inevitably. But it's much less than you probably think it is. What is really sustainable is what Harlan said in the previous question. We think under the trend demand increase, is more like closer to 20% year-on-year than what perhaps in dollar terms you are representing. And how long would it last? Who knows? It's hard for me to figure out because I've been wrong so many times, and this is now going on into the almost 22 is done and is strong. We're now booking, given our lead times I indicated, in 23. And 23, I think, will be, at least the first half of 23 will still be pretty close to the same. And it's the latter part of 23 and 24 that we have to figure out whether there's enough supply that will start coming in to basically, address what is today and what we're seeing an extremely strong demand environment, whether it's from enterprise, telcos, and service providers, and hyperscale. All three are strong.
Got it. So price stickiness perhaps can continue into 23. I just wanted to clarify that.
At least the first part of 23, yes.
Okay. Thank you, Hock.
Thank you. Our next question will come from Stacy Rasgon with Bernstein Research. Please go ahead.
Hi, guys. Thanks for taking my questions. Hock, I wanted to ask about gross margin. So you did like 75.5% in the quarter, 71% for semis, and if I sort of like squint at your guidance, it implies gross margins in Q2 at least at that level, if not even probably higher. And this is, amid cost increases and everything else. So, I mean, how do we think about like the limit of this? I know you always talk about margins kind of going up 100 basis points a year. They seem to be doing even better than that. Do we just keep modeling them going up from here, or do you think they take a pause? Are there any other drivers like into the back of this year mix or anything else that would sit on that? Just how do we think about that just given the levels that they're sitting at right now?
Oh, well, and, I could trot out my usual statement because it happens to be true, which is year upon year, under normal situations, we see this around 100 basis points expansion of gross margin on our semiconductor front. You get that. Now, Kirsten just indicated we did better than that in semiconductor, and I guess the reason why we did better than that this season, so to speak, is if you hark back to my remarks, there's a lot of launch and deployment of new generation products that I mentioned. We're talking about in networking, Tomahawk 4, and much more Trident 4, which is more towards some data centers that use in enterprises. Tomahawk 4 used in hypercloud, that new generation. Then we talk about Jericho being deployed, the latest Jericho being deployed in the backside networks of machine learning, AI, GPU interconnectivity. That's a whole new application. Then we talk in server storage. I talk about a whole slew of new generation solutions which we put in place towards basically for new generation leading edge servers out there from the guys who do those servers. And with those new generation, we get that better margin. So I guess the additional input I put in is a lot more new generation products coming out now. Happens to be in 22. We're seeing happen. And of course, we are in this environment thankfully able to pass on our cost increases to to customers. And that all adds up to a fairly decent gross margin set of results. But do not let that be an indicator, please, that it is something that will be a 200-300 basis points expansion year on year. We still believe normal situation is still be just on average 100 basis point expansion.
Got it. But as long as you can keep the new products coming, we should still be able to see that 100 basis points even from here.
Yeah, and by the way, it's not just me having to come out with new product. There's a pull. the customers, the applications of our markets require us, and that's the beautiful thing about the semiconductors and technology, there always is a need for a next generation better products, whether it's performance, power, whatever. There's always a pull, and that product life cycle is what enables us to develop these new products, and our margins will keep expanding.
Got it. It's helpful. Thank you so much.
Sure.
Thank you. Our next question will come from Ross Seymour with Deutsche Bank. Please go ahead.
Hi, thanks for letting me ask a question. Hock, thanks for the information on the backlog for the semi business. It's good to see that rising as much as it did sequentially, especially considering the lead times stayed flat. While the magnitude is impressive, I really wanted to ask about the profile of that and how it may or may not be changing. So as that additional backlog comes in, given all the moving parts between enterprise and cloud and broadband and wireless, et cetera, any sort of changes in the profile of that backlog that you find to be interesting, either in a positive or negative sense, that'll give us a clue about future growth drivers for your company?
That's a good question, and I implied in some of my remarks, but let me take it directly. Yeah, enterprise demand spending is the strongest driver that we're seeing today. And it should be no surprise, because something we've said since last quarter and the quarter before. Enterprise has recovered, more than recovered, it's on fire, is the best way to describe it. Enterprise spending on IT is, as we perceive it, on fire. And we are seeing a big part of that. And that's not to say that hypercloud and telcos are not adding to it, but not as strong as enterprise recovery.
Any negative surprises in that? You talked about the positive side. Is there anything that's been surprising on the negative side?
No, not really. It's just I think there's a lot of pent-up spending. There's a lot of need for a lot of enterprises to upgrade, and that's also what's driving, as I indicated in my remarks, a lot of on-prem campus switching investment going in. Look at even Broadcom. We've been using Wi-Fi in our hotspots, in our access gateways through the campus. A key part of it is wireless connectivity, Wi-Fi, so to speak. We've been running Wi-Fi 5 for many years. Now is the time to move to Wi-Fi 6, 6E, and we're not the only one. We're seeing across the board very strong demand from lots of enterprises wanting to upgrade connectivity as offices start to slowly open up.
Thank you.
Sure.
Thank you. Our next question will come from John Pitzer with Credit Suisse. Please go ahead.
Yeah, guys, thanks for letting me ask the question. Hock, usually at this point in the cycle with lead times extended as much as they are and you guys getting pricing power, the big concern on Wall Street is to what extent is the demand you're seeing real demand versus perhaps your customers building inventory. And I know you're less consumer focused than most, and so maybe inventory builds are less relevant in some of these infrastructure markets. But I'm wondering if you could give us your perspective on, or at least what you guys try to do to scrub the backlog to make sure it's good demand. And if you think it's good demand, I'm kind of curious, you've always had a very realistic view of what the long-term growth rate for your semi business should be. Is that beginning to change? And like many of your peers who have put up a higher kind of new CAGR, are you willing to go there right now?
Let's answer the first question first, and let me go to the last one and the best at the end. But on the first part, yeah, as I've said in previous earnings calls, and I'm more than happy to reiterate it here, which is we are very, very concerned, obviously, that we could easily build up inventory in various parts of our demand environment. just because we ship according to what customer sending in orders as their customer request is. So we don't. We actually spend huge amount of bandwidth of our operations and salespeople in this environment to make sure we get products to any particular customer just when they need it. Not any earlier, and hopefully not too late either, because we like to address customer and a real need in that regard. But what's very, very important to us is not to ship excessively and build up inventory, whether it's in the customer inventory, in distribution. Though the nice thing about our business in semiconductor is this: 75% of our revenue comes from just about 100 customers, and they're direct. The last 25% go through distribution. 75% is direct to 100 customers. We have enough salespeople, we have enough visibility on these customers to know exactly, pretty closely, we like to think, what they need and ship to what they need and to what exactly they need. And when we do all that, I said it before in last earnings call, true end demand growth, true growth, we have been seeing in 21. It's about 20% year-on-year improvement. Now, we now tack on the fact that material costs have gone up in 22, so there's an addition beyond 20%. But I still believe it's about 20% in response to earlier answer in this environment, because the last upcycle we saw in 2017, it was 20% year-on-year improvement. It wasn't stronger than that. And by the way, we sell mostly those big core system on a chip into any platform that our customer builds and sells out. We do and generally we get very good visibility. If we were to sell more of the peripheral chips, the secondary chips that adds up to the total platform, and that costs a fraction of what our system on a chip costs, then perhaps you will not have that visibility, and we believe there are a lot of pockets of those inventory in the wrong places because of unbalanced chipsets sitting out there. But if you, for example, if you are building a data center and you need 1,000 Tomahawk 4s, believe me, you will not buy more than 1,050 Tomahawk 4s. But if you're buying a voltage regulator, you probably buy 2,000, 3,000 of those voltage regulators just in case. And that's the difference in what we think. So we think we get a good sense of what's out there. And the kicker here is the price increase that was passed on because of wafer cost and substrate cost increases, which makes it go over perhaps what we think is a sustainable level. Now, to answer your longer-term question, no, I don't think on a long term, say next 10 years, would the CAGR change? I think people who say the CAGR change, frankly, are probably dreaming, because there's no evidence on our side to show why this industry, which is relatively mature, semiconductor industry, should suddenly spiral into a different trend growth rate. We have seen our last 10 years compounded roughly 5% annual growth rate. And there's nothing to indicate, frankly, why you would not be that way for the next long-term 10 years. Now, it won't be 5% every year. Obviously, we're not at 5% this year. But on the long term, I still think that trend has not changed.
Perfect. Thank you very much.
Sure.
Thank you. Our next question will come from Toshiya Hari with Goldman Sachs. Please go ahead.
Great. Thank you so much for taking the question. Hock, I wanted to ask for your thoughts on capital allocation. It's been a while since your last meaningful acquisition. A lot of things are going on from a macro perspective. Rates are going up, and obviously the economy is a little bit squishy. You just spent $2.7 billion on buybacks. Just curious how you're thinking about allocation of capital, any changes to how you think about M&A, and your appetite for M&A going forward. Thank you so much.
Thank you. And really, in last quarter, we were very clear about capital allocation plan, at least for 2022, and which is, frankly, we're still looking for acquisitions. We've just been very, very, as we usually do, being very thoughtful and selective about the assets we would acquire, but very much so, we're still in the market to look for great assets for us to acquire, and we have the capacity to handle it. And in the meantime, given 2 years, 20 and 22, when we haven't done anything on acquisitions and have been earning and generating lots of cash, we have taken on, other than paying dividends and maintaining the policy on dividends that we have outlined for the long term, we have decided for fiscal 22, for actually calendar 22, to put out that buyback program of $10 billion. We've spent $2.7 billion of it so far, and we have probably most of the year to go, and we will likely use all of it up evenly over the next 9 months of the remaining year, and that nothing has changed. And we believe we still have the capacity to do a good size acquisition.
Thank you so much.
Thank you. Our next question will come from Pierre Ferragu with New Street Research. Please go ahead.
Hi, thank you for taking my question. I'd love to hear whatever updates you can give us, Hock, on your ASIC business in semiconductors. And what I'm wondering is, how is business trending compared to your other segments in semiconductors? And do you see your ASICs taking share overall with your hyperscale clients, or is that just growing in line with the rest of the market, or actually below the rest of the market?
Okay, let me paraphrase your question the way I would probably be able to answer it and see if it's the right thing. What you're saying is, see, we have a product division that does ASIC, custom chips, essentially, for usually large customers. And that's a good size business for us. And a big part of that business, to address what you're saying here, is now currently, though not in the past, but more recently in the last few years, towards the hyperscale players who are wanting to develop their customized and dedicated accelerators for specific functions and workloads, mostly related to, for instance, machine learning, AI, also to do with video transcoding, and also gradually increasing virtualization and orchestration of data centers. All those that are customized silicon accelerators to enable these hypercloud guys to run their workloads better and more effectively. I believe that was your question. And the best way to answer your question is, year on year, this quarter, Q1, we grew revenue in this offload computing sector, which is all ASICs, north of 50% revenue year upon year. All right? I hope that answers your question.
Yes, thank you. That's perfect. Thank you so much.
Thank you. Our next question will come from Tim Arcuri with UBS. Please go ahead.
Hi, thanks a lot. Hock, I had a question on your wireless business. It's been very strong, but you've been recently talking about some trade-offs that one of your customers making on the FBAR side, and maybe making it a little even more concentrated on a single customer. And I know that you considered selling this business some time back, but does the even further further revenue concentration, does it make you rethink maybe how committed you want to be to that segment, and maybe whether you could redeploy this capital into another market, especially as things might be changing on the modem side. Thank you.
Okay, good question, and my answer will be very simple and direct. We've always indicated our wireless business is one customer, largely, our North American OEM. And you know what? They're a very good customer, they're very strategic, and we are not only selling one product, but selling multiple products which are very strategic to us, and I believe also very important and strategic to them, which is what makes a partnership very sustaining. I see this as a very long-term sustaining partnership in the sense of the products we develop, we collectively call wireless, and because it goes into mobile, a lot of mobile devices, though not entirely, but most of it goes into phones, it goes into wearables, it goes into pads or tablets, and it goes into not so mobile, but many of them are, into even notebooks. But it goes into all the stuff, and we develop and provide something like about 5 different critical technology products to this same customer. So it has over 10 years now developed into an extremely sustainable and strategic relationship. Clearly from our side, yes. I like to believe from their side the same thing.
Thanks, Hock.
Thank you. Our next question will come from Edward Snyder with Charter Equity Research. Please go ahead.
Thank you. Well, since we are talking about wireless, I wanted to follow up with that. Thanks for that answer, Hock, but I want to step back and maybe look at the longer term on this. When you bought Broadcom, it kind of shifted the narrative from we don't really need revenue growth. We're mostly looking for cash flow and high margins, which worked out very well. In wireless, you got a little bit different animal with Samsung on the way out because they shifted their phone strategy to more cost-centric and less performance-wise. It made sense for Broadcom not to participate there. And your largest customer is doing fine. It looks like they will be for years. But as we've already seen on the high-end 5G, the growth in revenue or growth in content is slowing. And by all measures, it will likely stagnate in the next 3 to 4 years. In that kind of environment, and especially if you're not doing these custom designs anymore, and it's just a given that revenue may not grow, if margins are affected, what do you do with it? I mean, you've not ever embraced a business where both revenue is flat to down and margins are in decline. I think the question a lot of folks have is, what could you possibly do? It's so large and there's so few suitors for it. It's kind of puzzling in 3 years or 4 years what the strategy be with wireless. Maybe you could help shine a light on that. Thanks.
Oh, that's an interesting thing, Ed. Here it is. All our businesses, I just want to remind you, in our view, as I said, in the view of all semiconductor segments itself, it's not a high growth business. You guys like to think, because probably there are a few companies out there who are trying to grow in a business that doesn't grow. 5% is what it is. And so it's a business that does grow. But in dollar terms, overall, mid-single digits. I call it a slow growth industry. Within it, however, it still evolves new generation of products constantly. That's the unusual, unique thing about semiconductors. It keeps evolving. Not disruptive, much as people like to say they are disruptive. My view is evolutionary. But that evolutionary creates new opportunities for basically selling a better product, a more valuable product to the same customer for the similar application which the customer can then monetize back on their own. And that's really all it is. And what we are doing here in wireless is no different. And tell you something also very interesting. Every product we sell in wireless is in effect a non-standard product. It is customized. It is customized for the needs, for the unique needs and particular requirements of that particular customer. That's what makes us so successful, and that's what makes the partnership so sustainable. We develop technology in the form of the products that we do, whether it's an RF with FBAR front-end module, or whether it's pure silicon with some SDK, a lot of SDK software, where some unique high-performance mixed signal analog product, all of which we do to this customer. We do it to meet their particular requirements, which allow their products to be at a level that's very differentiated from their own space, in the competitive space they are in. And that's what makes it very unique, and that's what makes this thing keep going. But we're not looking for, in any end market we are in any product line we are in, for high growth. High growth in semiconductors comes in spurts and do not last. If anybody tells you otherwise, please don't believe it, because it has never happened.
Thank you.
Thank you. And we do have time for one final question from Vijay Rakesh with Mizuho. Please go ahead.
Yeah. Hey, Hock. Just a question on the networking side. Obviously, very strong growth, up 33% with the Tomahawk and DPU, I guess. What do you see the long-term growth there, meaning if you look at the next 12 to 24 months on the networking side? I had a follow-up. Thanks.
Okay. The next 12 months, it's pretty good. We have visibility, and we kind of indicated in our answer. 24 months, harder for me to tell you. If you ask me what do you think over the next 10 years, I'll tell you what it is. Mid to high single digits. And because it's consistent with story. There is no segment, don't believe anybody telling you otherwise, that will have a sustainable growth rate in this space. It's share changes, maybe. So, but next 12 months, very good growth rate is what I indicated.
Thanks. And one last question on the software side. Obviously, since December 8th, when they announced the big buyback, obviously software valuations have become much more attractive in the last, might be down 30-40% there. But do you have a target in mind as to what you think that software business should be? It's like 24-25% of revenues now. Are you looking to build it up to half of your business, or is that a long-term target that you're putting out there? Thanks.
Hate to tell you, I don't have a strategic plan here. My plan, or a numbers plan, it's our strategy in acquisitions and growing this entire Broadcom platform is more about identifying very, very strong assets out there, and which are actionable, and then making a deal and buying them and integrating in our platform. They got to meet our requirements of quality of the assets, of the product, of the business model, to some extent the product characteristics is very mission critical. And then after that comes the price. For us, after that is the price. Because you recall, the way we run those software businesses tends to be different usually from the way the party we buy from runs it. And because of that, we are able to create the financial returns consistent with a business model that we put in place, fairly different from what the existing business model is in most software companies out there. All right.
Great. Thanks, Hock.
Ladies and gentlemen, thank you for participating in today's question and answer session. I would now like to turn the call back over to Ji Yoo, Director of Investor Relations, for any closing remarks.
Thank you, Cherie. In closing, similar to our networking, broadband, and storage teach-ins in fiscal 21, Broadcom and Deutsche Bank will be hosting a teach-in of our custom silicon business on Tuesday, April 19th at 12 p.m. Eastern, 9 a.m. Pacific. Hock will be joined by Frank Ostoich, General Manager of our ASIC Products Division, and Vijay Janapati, General Manager of our Physical Layer Products Division. Broadcom currently plans to report its earnings for the second quarter of fiscal 22 after close of market on Thursday, June 2nd, 2022. A public webcast of Broadcom's earnings conference call will follow at 2 p.m. Pacific. That will conclude our earnings call today. Thank you all for joining. Cherie, you may end the call.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.